Afternoon, everyone. I hope you all doing well and having a great start to the year. We're just going to have to wait a couple seconds before we get started just to see if everyone's registered and let everyone log in and we can all go from there. But yeah, guys, thank you so much for attending. So, as you may be aware, this is the second Wealth Academy series for what we're running at Rand Swiss, and it's actually the first one for the year. So let's hope we can do quite nicely here. And if there's any questions, please feel free to ask. Also, please be aware that this webinar will be recorded. So if you have to jump out like halfway through or anything like that, it will be recorded and uploaded to the YouTube channel, the Wealth Academy channel. I'll send everyone a copy of the link to the recording after this, so you guys can watch it at any point in time. But yeah, guys, I think the big thing here is let's please make it as interactive as possible. If you have any questions, please feel free to ask. I'll answer all the questions at the end of the webinar. Alternatively, you'll see both myself and the other wealth advisor, Yaku. Our contact details are there. So if you'd like, you can always just pop us a private mail. From there, we can then take a look through your guys' questions and answer them from there. So I think firstly, just unpacking the Wealth Academy webinar and the series that we'll be running. This is a series we're going to be running, and the whole objective here is just to unpack the various different sort of accounts investors have available to them and different asset allocations, and almost just unpack the whole investment wealth planning universe. I remember from the first webinar I did last year towards the end of the year, I explained how difficult all the different terms are. And I said, when I first joined the industry, I was a bit taken back because you're hearing all these terms and these different products, and there's tax regulations around them and estate planning regulations. So it can be very, very daunting. So we're hoping with this webinar, we can unpack obviously all those different terms and all those different strategies and make it easier for you guys to understand. So just touching on, like I said, the wealth and advisory self-service offering at Rand Swiss. That's both myself and Yaku who are involved with the wealth management, and I think it's been a good start so far to the year. Him and I have a great relationship, and we're really managing to grow and expand that side of the business. So the agenda for today, so the topic will be tax-free savings accounts. These are obviously a very, very hot topic at the moment, especially with the tax year coming to an end. Just a big thing, remember the tax year doesn't run in line with the calendar year, so it doesn't run from Jan to December. It runs from 1 March to the end of Feb. So as we approach, obviously, the end of February, I can't believe that Jan's already done for 2024. But as we approach the end of Feb, we will then have the end of the financial year. Now, in terms of how we're going to be tackling this topic today, we're going to look at firstly the taxes payable on investments. Secondly, we're going to look at the history of the structure. Then we're going to look at some features of the structure. We're going to look at the potential underlying holdings you can use. And finally, I'm going to finish off with a case study. I love the case studies because it essentially unpacks what's a nice summary version of everything we've discussed. And the case study topic today will be a simple way to make your children financially independent. So that is a very, very big topic, a very big demand we have with our clients. Lots of clients may know, can they set up tax-free for their children? The answer is, of course. And you'll see from the case study at the end, it is really a great way to assist your children with becoming financially independent. So firstly, taxes payable. I'm sure we're all obviously familiar with the term from Benjamin Graham, where he reminds us of the two certainties of life, death and taxes. And I think taxes is obviously something we can't avoid, but it's a bit of frustration out there. I think what confuses a lot of people with taxes is, again, they're unaware of the potential taxes they have payable. They're unaware of why they need to pay taxes for certain things. So that's why I want to almost unpack today. So when it comes to investing, there are ultimately 3 types of taxes that are payable. It's interest on your income, it's capital gains tax, and dividend withholding tax. Now, before you panic, it's not like all 3 of these sort of taxes are taken on your investments. It's typically one or the other. But I think the big thing almost when you unpack is typically investors are a little bit surprised when they realize there are taxes payable on investments. Reason being is, I mean, besides retirement funds, typically when people invest, they invest their after-tax money. So you earn a salary, you pay tax on that. From the net, income, you then decide to invest it. I think the frustration we've sometimes seen amongst clients is, I'm using my after-tax money to invest. I get growth on that. Why do I still need to pay tax on that? And ultimately, it is just obviously the way it is. It's the same with almost every country worldwide. But I think the big thing is you want to understand what the taxes are payable, why are they payable, how are they charged, and from there, you can actually see that the benefits of a tax-free is that there's absolutely no taxes payable. So tax-free doesn't have these three where other sort of investments would. So firstly, I want to look at the taxes payable on interest income. So how are you taxed on this? This is essentially added to your taxable income. So where do you typically feel, or where do you typically get implicated for tax for income, which is interest tax? This will mostly happen when you have money in the bank. So what we can see from this example here is if an individual is in the was earning 800,000 and they're in the tax bracket of the highlighted block, so 673,000 and 857,000. So that's the tax bracket they find themselves in. If an individual is earning 800,000 and they also have a large cash deposit in the bank, and that cash deposit is giving out interest per annum, and the interest they're earning from that is 100,000 Rand. SARS, when the tax year ends, SARS will then say, nope, the individual never earned 800,000. They actually earned 900,000. So their taxable income will no longer be 800,000, it will be 900,000. What happens is the banks issue you with what's known as an RT3B, and that shows the interest you've earned on the capital lump sum you've had in the bank. But before we panic, what is nice is SARS generously give us an exemption every year. So if you're under the age of 65, every single South African investor is given a 23,800 allowance, where the first 23,800 you earn is completely tax-free. So if we're looking at an interest rate of roughly 7%, you'd be able to almost invest 340,000, and then the interest you earn there would essentially be free of tax because of your annual exemption. If you're over the age of 65, you then have a 34,500 allowance. That means that you can have up to about roughly at a rate of 7%, about 492,000 Rand in the bank, and the interest you're earning on that would be free of tax. However, if you do have more than that, and you are earning a better rate than 7%, then you would have to pay the amount over those exemptions would be considered in your taxable income. The next form of tax payable is capital gains tax. And this is the more regular one we see, especially with wealth planning, because we obviously set up clients for more long-term investments. And we typically invest clients in products that are capital in nature. And therefore, you obviously pay capital gains tax. So capital gains tax is essentially the profits you make on your investments. What's very important to note there is it is still relevant to your taxable income. So how is capital gains tax calculated? Well, let's just make the assumption that someone is in the max tax bracket of 45%. So you can see the highlighted block there. They're earning more than 1.8 million per annum. So this is this high net worth individual. They're in the max tax bracket, and they've got a tax rate of 45%. Now, if they make a gain and they make profits on their investments, what SARS do is they say, okay, perfect, we're going to have an inclusion rate of 40%. So 40% of your gain times your marginal tax rate, which in this case here would be 45%. And there you will get your effective CGT rate, which in this case would be 18%, 45 times 40. This would fluctuate from investor to investor, depending on where they find themselves on the tax rates. So for example, if you're in the lowest tax bracket, if you're earning under 237,000, you would then be in the 18% tax bracket. What you would do there is your tax rate would be 18%. You times it by the inclusion rate, which is 40%, and therefore your effective CGT rate will be 7.2%. So that was very important to note. So capital gains tax does fluctuate from investor to investor, depending on where they find themselves with regards to their taxable income. Now, again, SARS also do give us an exemption. So very similar to the interest, you also do get an annual exemption. In this case, the exemption you get is 40,000 Rand per year. So in this case, if an investor made a capital gains, they made profits of 30,000, there'd be absolutely no tax payable because you've given a 40,000 allowance. If investors now, for argument's sake, don't use their 40,000 allowance for this financial year, and for next year they make profits of 80,000, that 40,000 cannot be carried over. It doesn't get rolled over. It resets every year. So that's why when we do wealth planning, and that's why it is very important to actually speak with your advisor sometimes. If you do want to make a sale of some assets, it's very beneficial to sometimes look at using your 40,000 allowance, because remember, you can't carry that over to the next year. So again, speak to your wealth advisor. If you do want to potentially make some changes to a portfolio now before the financial year ends, and you want to utilize that 40,000, it's very, very important. Finally, the last tax sort of payable when it comes to investments is dividend withholding tax. So this is essentially taxed at 20% and is paid, by either the company or the broker or the list platform that's housing and that's doing the admin for the investment. And that is then paid, obviously, in the form of dividend withholding tax. So let's just use a very, very simple example here. Let's just say you own shares in British American Tobacco. They have a profitable year and they pay dividends to their investors. 20% of that dividend would have to go to SARS in the form of dividend withholding tax. So in the example there, if an investor receives 1,000 Rand from a company, the investor will only receive 80% of that 1,000 Rand. So in that case, 800 Rand. And the 20%, which will be 200 Rand, will then be taxed. So now that we know the sort of three sort of ways you can be taxed with investments, this is what I want to first unpack that, and then I can unpack how beneficial tax frees can be. So now if we look at the history of the structure, so National Treasury discovered a very, very alarming stat, and that is that only 6 out of every 100 South Africans can retire comfortably. So that means on average, only 6% of South Africans can actually afford to retire comfortably. This is a major concern. I mean, we've definitely seen it. I mean, I've been in the industry now for close to 8 years, and I sit down with clients, and the problem is it's a range of different things. Obviously, it's the affordability. I mean, people can't, afford to put away large lump sums of capitals. Often most of the people in this country do live day to day. So that is a very big concern. The second factor is people often start too late. So the problem is with only 6% of South Africans being able to afford to retire, the other 94% end up relying on government or family to then obviously get them through their retirement. So what has National Treasury essentially introduced? In 2015, they introduced the tax-free savings accounts. I mean, this is even quoted from SARS, and the tax-free savings investments was introduced to incentivize household savings. Obviously, what they want to do here is they want to try and incentivize people to save. Because if you could see from those previous slides, people are thinking, I'm paying income tax. After I get my net income, I then try and invest it. And what you can see there is there's different ways I can be taxed on the growth of that. So what National Treasury has done is they said, guys, please try save, please try increase household savings. And the best way they did that was they introduced a product where there's absolutely no tax payable. So remember, it's in the name, tax-free savings accounts or tax-free investments accounts. There's absolutely no tax payable. So all those 3 taxes I told you about earlier, they're not applicable to a tax-free savings account. Very, very important to note. Now, if I unpack the features of the structure, what I typically find is it's all going well. Now about tax-free savings accounts, it's free of tax. But how does it work? I've inherited R1 million. Can I put R1 million in, or can I put in money, take money out? What I'm going to unpack now is the features behind the tax-free savings accounts. So firstly, I want to unpack contributions. So it's great government give us this flexibility and this sort of tax-free investment accounts, but that does come with some contribution constraints. So investors can only contribute a maximum of 36,000 Rand per year or 3,000 Rand per month. Now, this has changed over the years. So in 2015, when the tax-free savings account was launched, you could only invest 30,000 a year. Then in 2018, they amended that to 33,000. And quite recently in 2021, they've increased that to 36,000 Rand a year. What is incredibly alarming is I've seen many, many client cases. I mean, I actually was dealing with a client last week where their tax-free savings investment contribution was still 33,000. And that's alarming to me because, obviously the advisor hasn't been monitoring it correctly and they aren't capitalizing on that extra 3,000 Rand a month, or 3,000 Rand per year allowance that's obviously changed since 2021. So guys, please, very, very important to note, if you do read some articles dated back in 2015, you'll see the contribution limit is 30,000. That has changed now to 36,000. So that's the maximum you can contribute per year, or 3,000 Rand a month. Now that's per year, per month of contribution maximums. In a lifetime, an investor can only contribute a maximum of 500,000 Rand. So that means that it takes roughly about just a bit more than 14 years to max that 500,000 allowance up. Now, in terms of it, that's why we say to investors, it's very, very important to start as early as possible. Because if you really want to gain from the tax-free growth that's offered with this account, you need to be putting in the largest lump sum possible as early as possible. So I understand affordability is an issue for clients. I mean, tax-frees can range from 500 Rand a month up to 3,000 Rand a month. So don't feel like if you can't afford the 3,000 Rand a month, the product's not suitable for you. Start somewhere. I mean, when I started my tax-free, I was doing 500 Rand a month and I increased it to 1,000. So you don't have to do 3,000 Rand a month, but that is the maximum you can contribute. But the big message I want to get across here is start as early as possible and try to put away as much as possible to really benefit from that tax-free growth. Just a couple of warnings. That annual contribution limit of 36,000 is per investor, not per account. So if I go to Alan Gray and I put away 36,000, and then I go to 91 and I put away 36,000, the two different institutions are not going to know I already have a tax-free. They're going to view it as, okay, Carl's opening up a tax-free with us. But if you try to do that, when you do your tax return at the end of the financial year, SARS will know you've opened up multiple tax-frees and they'll whack you with a 40% penalty on any excess contribution above 36,000 Rand. So please, 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 when setting up a tax-free, remember, you can only put away 36,000 Rand per year. That can be spread across 3 different accounts. You can have, 10,000 in an Alan Gray tax-free, 10,000 in a Momentum tax-free, and 16,000 in a Signia tax-free. That's perfectly fine. But you still have to be within the 36,000 Rand allowance, and you can never, ever breach that. And if you do, you then get whacked with 40% with any excess contributions. Now, when it comes to withdrawals, what people are typically very, very surprised about is you have all these tax benefits. It's very, very similar tax benefits that you would get within like a retirement fund structure. But the big benefit here is that the structures are completely flexible. So that means that there's no real minimum investment term here. So that means that you can put in money and take money out. However, we do not really encourage this behavior. Reason being is that whatever you take out, you can't put back in. So you'll see from the second point there, any reinvestments will be regarded as new contributions. So if you put away 36,000 Rand on the 1st of March, and come the 1st of September, you take out 10,000 Rand, you have still put in your 36,000 Rand and you can't reinvest that 10,000, because if you reinvest that 10,000, SARS is going to assume you put away 46,000 Rand for the financial year and you'll be taxed 40% on that excess contribution of 10,000. So it's very important to note is it's great that this investment offers flexibility. And I mean, we've seen enormous interest from clients because, what we've seen with some clients is they've got retirement funds. And it's great because it offers enormous tax benefits. But then come immigration, it's a bit of a nightmare to try and liquidate that asset if you're younger than age 55. Or what I've seen, especially in COVID, when people were unemployed and they tried to then ultimately access their retirement funds, they couldn't because they were younger than the age of 55. Tax-frees offer you that flexibility. Again, it's not encouraged to use it as a short-term savings account, but it's nice to have that flexibility for when emergencies happen. If you all of a sudden lose your job and you're 48 years old and you need access to capital, you can pull it out your tax-free. That is perfectly fine. There's no minimum investment term. So that's the benefit with tax-frees. A bit of a horror story with withdrawals is I had a case about 4 years ago where the client wanted to transfer their tax-free from one platform to another. And she went to the company that was housing the tax-free at the time, told them that she wants to move away from them, and the consultants at that platform handed them a withdrawal form. And the guy ended up withdrawing about 250,000, as opposed to transferring it. And then the client contacted the new platform and said, listen, guys, I've got the money. When can I invest it? And the platform said, no, we haven't received any transfer forms yet. She said, no, but the money's in my account. That was one of the worst stories I've heard, because all that happened in that client's case was they had lost that 500,000 allowance. So remember, in your lifetime, you've given the 500,000 allowance. If you withdraw 250,000 Rand, you can only put away a maximum of 250,000 Rand. So you've really decreased the capital lump sum you have available to grow tax-free. So please, 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 guys, be very, very careful when having tax-frees, especially when it comes to transferring them. Make sure you're dealing with make sure you're understanding everything. Make sure you never fill out a withdrawal form. Make sure it's always a transfer form if you want to move tax-frees across. Now, underlying holdings. So I've had many questions with regards to tax-frees where people say to me, I'm loving the product. I love the tax-free benefits you can offer, but I don't like this tax-free because I actually want to go through my bank where I can invest in cash. And that's the source of growth. With the tax-free that is simply a structure. Inside the structure, you have a very wide, universe of available holdings that you can invest in to grow the capital. So that's important to note. So tax-free is simply a structure. Within the structure, you can really get fancy with recommending different holdings to grow that capital. So what are the three major holdings I've seen in tax-free structures? I've seen cash, balanced funds, and offshore ETFs. So firstly, cash. Where have I typically seen cash assets with regards to tax-frees? That's in the bank. So typically, if you invest in your major banks, you are putting your money essentially in cash and you're earning interest-like returns. Now, Maya on Money, she's a fantastic financial journalist. She actually made a very, very important point the one time, and she said she never understands why people invest their tax-frees in cash, because if you remember from that first slide I showed you with regards to the taxes payable on interest, every investor under the age of 65 is given a 23,000 allowance per annum, and over 65 given a 34,000 allowance per annum. So why on earth would you allocate your tax-free capital into, why would you allocate your tax-free investments into a cash sort of instrument when you're already given a 23,000 Rand tax-free allowance? You might as well just put that in a normal bank account and earn tax-free interest in that anyway. Another point she raised is she said that she's never really thrilled with the naming of tax-free savings accounts, because typically the way it's marketed amongst banks is it's almost a short-term savings accounts where you put money in, take money out. So we actually prefer to refer to these vehicles as tax-free investment accounts. Try to view it as more of a long-term vehicle, not a savings account where you put money in, take money out. Because you might as well just open up a normal deposit with your bank where you can then earn tax-free interest up until 23,000, as opposed to open up a tax-free and having these sort of holdings. So that's the first allocation where you can simply get them through your bank. The second is if you do it through a list platform. That's where you typically go to your platform and you can invest in balanced funds. And you can see balanced funds comprises of how you get the term balanced, as it's balanced in terms of the asset allocation mix. You're investing in some local equities, so some of the local stock markets, some of the offshore stock markets, some bonds, some cash, some property. You have various different asset allocations that give it a bit of a balanced sort of mandate risk profile. The final one is through a stockbroker, and that's essentially an offshore ETF. That's where you can essentially take your funds, put them 100% offshore in the stock market, earning growth. This is our preferred sort of style, and I'll explain the reasons why. So if we look at the asset allocations for these three different sort of styles when it comes to the holdings of a tax-free structure, you can see the first one, cash. It's 100% green. So you're 100% invested in cash. You're getting interest-like returns. And you can see there in the next column, which shows a 5-year return profile, you're getting roughly about 6% per annum in this account. The second is a balance fund. And this is typically, like I said, available with your list platforms. There you would be getting exposure to various different asset classes. You have some on the JSE, you have some exposure to the offshore markets, some exposure to government bonds, some exposure to cash, some exposure to property. That average 5-year return profile is delivering about 10% per annum. Finally, the offshore ETF approach. You can see there that bar, that sort of pie chart is 100% light blue. That means that you're going 100% sort of offshore equities. Now, the 5-year return profile there has been plus minus about 20% per annum. Now, I know typically that is a very, very high number. And every time I speak with clients, I want to make it as clear as possible that this is obviously a very long-term vehicle. So don't expect that sort of return for the first year. This is typically if you're going for a much longer period of time. Why is that the case? Why is it such a high sort of return profile versus the rest? Well, you earn interest essentially there in two different ways. Because you're investing offshore, you're earning firstly by, investing your money in offshore markets. South Africa make up less than 1% of the world economy. So when it comes to your money, you want to be investing in the other 99% of the world economy. You want to be investing in companies the likes of Microsoft, Visa, massive blue chip companies that you don't get exposure to on the local markets. Firstly, and that's the first reason, you obviously get exposure to much bigger companies, much bigger economies that can help that capital grow. The second is you hedge on rand depreciation. So if you invest offshore, you buy in offshore assets and the rand weakens, you make money on that rand weakness because you're ultimately holding the offshore assets. Now, what we've seen over the years is since 1970, the rand has lost an average of 6% per year to the dollar. So by simply sending your money offshore, you on average begin about 6% growth just on rand weakness. And then you obviously have exposure to much bigger markets. So when it comes to your sort of ideal return profile, that's where you're getting that sort of growth. Now, when it comes to fees, this is something we never want to shy away around Swiss because if you're paying high fees, that's obviously eating on that return profile. So you can see there, if you have your tax-free with a bank, the fees for having a cash sort of exposure is typically free, or there's typically a bit of a monthly account fee behind it. But there's no real AUM percentage fee. So that's a benefit with having it. But again, you're then getting 6% growth per annum. Inflation has been averaging around 6%. So you're actually not really making money in real terms. You're just keeping pace with inflation. So not really my preferred. I've never recommended a tax-free to be in a cash account. The second is via LISPs, and this is what most sole financial advisors offer in the market. And the fees there are actually quite high. You pay around about 1.5% per annum if you have it in balance funds. That's the average I've seen. So please, it's not sort of one balance fund. If you want, we can definitely do some quotes and we can do quite a deep dive to see what you would be paying if you have this sort of tax-free structure. But what we see there is the fee there is about 1.5%. Not bad when your return is about 8%, 10%. You beat inflation, at least you get a real return. The second, the final way of fees is with regards to the offshore ETF, and there the fee is 0.20%. That's the investment management fee for this account. Now, this is where we pride ourselves in, obviously with Rand Swiss having a stockbroking division. We are able to offer this to clients, and then you can see we're able to offer, very, very low fee for exposure to offshore markets, exposure to, getting your money offshore via the structure. Then if we look at the risk profile, you can see the risk profile for these different accounts. So cash typically has a very low risk profile. Now, what do I mean with risk? It doesn't mean necessarily you're going to lose all your money. It doesn't mean that at all. What it means is that there's more changes to price on a daily basis. So if you invest your money in cash, there's not going to be really any real change in the pricing. It has a very steady growth. So there's low risk profiling. In terms of balance funds, there's a medium risk profile. What that means is that balance fund unit trust price can be 100 Rand today, 106 Rand tomorrow, 103 Rand the next day, 97 Rand. So there's quite a bit of a moderate change in pricing with a balance fund. With regards to offshore ETFs, it has a very, very high risk profile. So there's a lot of volatility in that account. So what does that mean? You could essentially buy, the offshore stock market for 100 Rand, I'm just going to use Rand terms, and that could then go up to 110 Rand by the end of the day. The next day it can go down to 100 Rand again. The next day it can go down to 95 Rand. So on a daily basis, there's very erratic price differences, hence why it's got a very high risk profile. But again, if you're investing in these tax-frees, we recommend you do have a long-term time horizon. And when you want to obviously grow money over the long term, you want to be taking on higher risk. Again, this is our preferred choice for clients, but I've had lots of clients who are nearing retirement and they can't afford to take this high risk profile. And they are build a bit of a bespoke portfolio for them where we allocate some of their funds to bonds and cash to reduce that risk. But I think obviously I want to just unpack the various different underlying holdings available. So if we have to grade these holdings, how would we grade them? Well, we would grade cash accounts very, very poorly. The only reason why it hasn't gone F in this case here is because at least it's encouraging people to save. But ultimately, I think it's barely a pass because you aren't keeping, well, you're keeping pace with inflation. It's encouraging people to save. That's the benefits, I would say. The downfall is you aren't actually getting any real growth on your money. You aren't beating inflation. You could have actually used that capital and put it in a bank account in your personal name. You don't have to put it in the structure due to the exclusion you get per annum. In terms of balanced funds, I'll give that a B minus. Reason being is you at least are beating inflation. You are quite diversified across various asset classes. Why we've pulled it down quite a bit is because it's not your preferred asset classes. I don't think you want exposure to SA equities when you have such high exposure to SA equities and retirement funds typically. The other big downfall there is the fees are very, very high. In terms of the offshore ETF, I'll give that an A. Reason being is you have exposure to offshore equities in a very, very tax-efficient structure. You have diversification. So our preferred offshore ETF is the S&P 500. So you have exposure to the 500 biggest companies in the US. So that is clear diversification because if one of those companies do go bust, there's another 499 companies where your money is spread across. The only reason why it hasn't essentially got an A++ there is due to the risk profile. It is quite high. So please note, before investing in this sort of structure, consult with your wealth manager to ensure that this is the correct sort of time horizon you have with the investments. Now, if we have to look at these underlying holdings, the historical performance, what this chart shows us here is it shows us since inception, since Common's inception of these three different accounts, how has it performed up until the end of December last year. And what we did is we made the currency Rand, because obviously this is a Rand-based investment, but you still have obviously exposure to offshore assets. So if you look at the key there on the right-hand side, the first one is cash. And you can see there, cash is the red line. A very, very stable return. And you can see what I'm saying with the low risk profile, not a lot of volatility and pricing changes, but very, very poor long-term return. And then if we look at the balance fund, that's the blue, you can see there it has a bit of that moderate price change and that was obviously over COVID, experience a bit of pullback, but manages to beat cash. And again, that's why we've given it about B minus in terms of grade rating. The final is the S&P 500 ETF, which is in light green. And you can see there completely outperformed the other sort of underlying holdings there. But with that being said, again, what I want to highlight is that does come with a high degree of risk. If you look at a period like COVID, it had a pullback of about 30% when markets were in complete panic. That's the sort of risk, profile you would be facing. But in our eyes, it's worth taking that risk to get compensated with the return at the end period. So that's the three different sort of asset classes you can invest in when it comes to the structure of a tax-free. Again, I think the big benefit we have with being stockbrokers is we are able to invest the clients in ETFs, where I think typically the sort of advisor out there can only recommend the first two sort of offerings. And again, when it comes to our background, we are ranked the best stockbroker currently. We've been the best stockbroker for the last 3 years. So you are in safe hands when it comes to this. Finally, a case study. So looking at all the different elements I've discussed today, I think it would be quite nice to put in quite a nice case study in a real life example. Remember, I said to you the theme for the case study today is going to be how to ensure your children are financially independent. And I think there's quite a nice case we can look at here. So the case study for today, we're going to analyze the Viv Govender family. So for those of you who don't know, I'm pretty sure many of you are familiar with Viv. He's our senior analyst. In my eyes, one of the smartest I've ever met. Very, very intelligent when it comes to investing. Now, if I look at, wait, sorry guys, I think we've just faced a bit of a issue with connecting. Okay, sorry about that, guys. I think there was just a bit of an issue with connecting. So if I look at, like I said, Vivia, very intelligent investor. So he's now a parent and he's got a child. The child is called Baby Viv. You can see the dummy in the mouth there. That was Viv when he was much younger. So in terms of this, like I said, Viv is intelligent. He understands how compound interest works. And Albert Einstein was actually the person who coined the term, the eighth wonder of the world is compound interest. So Viv is aware of this and he's thinking about, obviously, how compound interest works. Now, remember, with compound interest, the longer you invest, the more you can utilize this great wonder of the world. So he looks at his newborn child and he thinks, let me set up an investment for him because my child has many years ahead of him, so he can really benefit from compound interest. So he decides to open up a tax-free savings account. And with the first year of the child being born, because remember, this product is applicable to every single South African citizen. So you can be 1 year old or you can be 90 years old and set this vehicle up. There's no requirements. You just have to be a South African citizen. So what Viv does is when the child is born, he opens up a tax-free savings account and he puts away 36,000 Rand for him. And he does so the next year when the child is 2 years old. And he does so the next year when the child's 3 years old. And he does this every single year. He's been a very, very, great parent in this case here, but he's really allowing his child to benefit from compound interest. And Viv does this for the next 14 years. He puts away the maximum 36,000 Rand a month. 36,000 Rand a year for the next 14 years, but he stops at 500,000 when your maximum is reached. All of a sudden, it's no longer child Viv anymore, it's teen Viv. So now he's 14 years old and he's got an enormous sum of money saved. He's essentially worth 1 million Rand, 1.2 million Rand. Now, obviously in 14 years' time, 1.2 million Rand doesn't have the same buying power that it has today. So in real terms, what is the real value of that money in today's terms? It will be worth roughly about 600,000, 620,000. So that is what a 14-year-old would be worth if you were to set up a tax-free savings account for your child today, paying away the maximum amount of 36,000 Rand per annum. And the big thing here is that you invest them in the right asset class. The sort of fund we looked at here was we looked at an average growth return of 12%. Now remember, 12% is the average growth return. If you had your money in the bank, you only get 6%. So you'd actually only get half of this. So you wouldn't have this full amount. Now let's decide, Teen Viv is very intelligent. He's just like his dad. And he wants to, benefit from compound interest. He's seen how much money he's made over the last 14 years. And he hasn't put he hasn't put a sense of his own money, but he decides he's actually going to leave this account for the next couple of years. So he decides he's going to wait until the age of 18 and he potentially wants to buy himself a first car. So he does. He doesn't add a single cent to his tax-free because remember, he's used the 500,000 allowance. He's just let the money grow behind the scenes. And that tax-free would be worth, estimated at the age of 18, 1.9 million. So just under 2 million. Again, what is that worth in real terms? It's worth 800,000. Now, if you think of 800,000, you actually won't be buying a sort of entry-level car like that. You can actually buy yourself quite a fancy car. So all of a sudden, Viv's child would have quite a nice sort of car available to him if he chooses to obviously withdraw the tax-free. Let's just say again, he's seen how much growth has been made. He's a very intelligent investor. He wants to utilize compound interest, and he decides to keep the money in the account till the age of 28 when he wants to buy a house. At age 28, based on that 12% annual growth return, that 500,000 that was initially invested would grow to 6 million Rand. Huge, huge, huge. Remember, that is all tax-free. He can withdraw that, get that paid into his bank account. 3 days later, it's in his bank account, completely tax-free. Not a cent is paid to the government. Now, in terms of, again, what would that be worth? 28 years from now, 6 million, unfortunately, will not have the same buying power as it does today. What is that buying power worth today? It's worth 1.5 million rand today, based on the sort of inflation, the average inflation rate. But let's just say again, Viv now doesn't want to buy a house. He wants to really utilize this tax-free vehicle and let it grow. And he actually wants to wait till retirement because he's, as much as he's been a good investor and utilized compound interest, he actually hasn't saved any money in his own capacity. He's been spending his money on other things. So he hasn't actually saved any money in his own capacity. So now he wants to make sure he's got enough for retirement. If Viv was to leave this account till age 65, he would have close to 400 million rand in the accounts. Now, I know this may seem like a bit of an inflated number. I mean, it's absolutely massive. But remember, this is 65 years of compound interest worked in your favor, and this is only a capital amount of 500,000. Now, this obviously alludes back to the point of a tax-free account for your children. This should be, if you obviously have the capital available, the first thing you should set up for your child. You put away hopefully the maximum of 36,000 rand a year or 3,000 rand a month. By the time the child's 14, you leave that account and you can have either, and you can see obviously the average growth returns. Let's just say Viv now is 65 years old. He's got 400 million obviously in the account. In real terms, what will that be worth in 65 years' time? Again, unfortunately, it won't be worth 400 million. It'll be worth 16.7 million, so just under 17 million rand. Now, if you had 17 million rand and you put it in a cash fund, which is paying you 6% per annum, you're not taking on any market risk, you're getting a steady return of 6%, that could give you an after-tax income of 83,000 rand or 84,000 rand essentially. So you could essentially, if you set up a tax free for your child, you put away 36,000 rand every year for the next 14 years, and you left it, and your child left it till the age of 65, and they had to retire. They could get, in today's terms, after tax, after fees, 84,000 rand per month. What an incredible vehicle. What a way to essentially become financially free. I know obviously these projections are very, very long, and who's to know what's going to happen in the next 65 years. The big thing we obviously want to try to get across here is that start early, utilize compound interest, don't withdraw from the tax-free unless it really is for emergency, and please, please, please allocate your capital correctly. These returns here have been working off an average of 12% per annum, not 6% that you would get at the bank, not 10% that you get with your average balance fund. So it's very, very important to consult with an educated wealth manager who can correctly align you with the right ETF or the right fund to ensure this level of growth. So guys, that's all on my end. Thank you so much for attending the webinar. Again, if you do have any questions, I am going to answer some of the questions now. I have received a couple, but if you do want to obviously pop us a mail, you can email either myself at Rand Swiss or Yaku at Rand Swiss. I'm based in Joburg. Yaku is based in Cape Town. If you do want a face-to-face meeting, our offices are in the JSE, so you can feel free. We can schedule some time. I can look at your tax-free, look at your other investments, see where you aligned. In terms of Yaku, he is based in Cape Town, so you can obviously meet him there. Or alternatively, we're always happy to do an online call with clients. We do travel quite a bit, so we can see some of the clients face-to-face. But please ask questions if you have any. If you do, you can pop us a mail. But just to answer some of the questions that have come through on the Q&A. So I've just received a couple. So the first is with regards to foreign dividends on tax-free savings accounts. Remember, with regards to foreign dividends, again, with the structure being a TFSA, there's absolutely no tax payable with regards to no dividend withholding tax, even if the company is domiciled offshore. So no foreign dividends tax whatsoever for this tax-free savings account. So with regards to the next question, the client's fear was just with regards to the currency, the rand. And they said, is there sort of any other currencies that we could look at when investing in this tax-free savings account? Unfortunately, with this product being a South African product, you always are going to have the payout profile be in rands. So you can invest in other currencies, but you can never ever have the payouts be in another currency. So you can essentially take your rands put in a tax-free structure, invest it overseas, but you can never have that payout be in dollars per se. So that's with regards to that. The next is, should a pensioner with an equity investment portfolio only for growth income take 36,000 from the portfolio and place in a tax-free savings account? Should this be done early or later in the tax-free year, and then invest that 36,000 offshore via an offshore ETF? So again, that was obviously a question. Just to sum that question up, someone's asking if they're already retired and they've got an investment portfolio and they want to obviously try and get tax-free growth on the investment portfolio, is it worth even opening up a tax-free? And if so, when should they look at opening it? And how quickly should they get their money offshore? So that's essentially the question. To answer that question, I would say if you are retired, typically you pull in an income from your investments. So it wouldn't really make sense to pull an income and then sometimes reinvest it. However, if you are trying to grow that capital, you've got a bit of excess capital, you then should definitely look at opening up a tax-free account due to the tax benefits you would get within the product. In terms of when you should look at allocating the money to the tax-free account, you can do it. Ideally, it is always best, the earlier the better. Start obviously when you're allowed to, so 1 March, or whenever you can. But what you could look at doing is what's known as rand cost averaging. So that means that you essentially put away 36,000 in a tax-free with a cash allocation, and every month you deploy 3,000 rand in the offshore equity. Why that could be quite beneficial to reduce risk is because you're having different entry levels into the market. So you put 36,000 or you put 3,000 rand away in the end of March. At the end of April, you put away 3,000 rand at a different market entry points. If the markets have heavy pullback in May, you then buy the units for cheaper. So you're entering the market at different points in time. So that's one of the ways you can look at doing it. But that's obviously, again, I would recommend you do speak to an advisor to firstly see if it is worth you setting up a tax-free if you already are in retirement. Because the last thing you want to do is pull money in retirement and you're pulling more income from your investments to essentially reinvest it. That isn't the best strategy. But if you do have excess capital available, definitely open up a tax-free. But again, this is offhand. It's not 100% advice. Obviously, please speak to me. I'll have to get a better idea on your whole portfolio. Then the next is, do Rand Swiss have their own ETFs? Unfortunately not. Well, actually not really, unfortunately not. We feel that there already are great ETFs out there for very, very cost-effective structure. So we would obviously just invest in those. We don't want to obviously charge an initial fee. But what we do is we obviously have our Rand Swiss wealth advisors choose the correct ETF portfolio based on your unique circumstances. So we can invest, like I said, our preferred ETF is the S&P 500, but we can essentially do ETFs in Eurostock, ETF in FTSE 100, ETFs in MSCI. So there's a whole range of different ETFs, which we could obviously build based on the client's unique requests. The next question is, how would you go about transferring your existing tax-free savings accounts to Rand Swiss? What would happen there is, if you are happy to obviously move it across, we would first want to know where's your existing tax-free sitting. If it is sitting obviously with the bank, there's different ways to go about it. We would obviously assist with regards to that the whole way through. So if you would like to move it across, please pop either myself or Yaku a mail, and we'll obviously list the requirements to move the tax-free savings across. Then with regards to the dividend yield for an offshore ETF, if you would like, what I can do is, if you wouldn't mind popping me a private mail, I can then send you the different dividend yields for the various different offshore ETFs. Like I said, we obviously independent advisors, so we've got ETFs in the S&P 500 and the MSCI in Eurostock. So those obviously all offer a different dividend yield. If you would like, you can pop me a mail with the ones you'd like to know, and I can just send you that. The next question is this considered an estate in assets in my estate? Unfortunately, yes, it is. This would be considered an asset in your estate upon passing. But what you could do is you can set up some tax fees with the beneficiaries, so you don't have to pay executive fees on that. The next question is, do kids need to have a tax-free account in their own name? Yes, they would. So if you do set up a tax-free account for your child, you would have to make sure that that tax-free is in their child's name. Ultimately, with that does come one risk, that they are essentially the owner of that account. So if that child is over the age of 18, they've got discretion on that account. They can do as and what they want with those funds. Even if you're the one that put the capital aside for them, you ultimately can't have the say to determine what they should or shouldn't do with it. If a child's 18 and they've got tax-free accounts in their own name, they can withdraw from it as free as they want. So that's why I definitely encourage, if you do set tax-free for your children, let them sit in some of the reviews. I've sat with lots of kids from 13 and older to explain the benefits of the tax-free in family meetings. We always encourage family meetings, just so they're obviously aware of the different rules and the ways to invest. The next one would be, would it be better to invest in pullbacks, so when markets have drawdowns, as opposed to now when markets are quite high? Again, we can obviously never predict markets, so it is quite a difficult statement to say. What I would advise for you, if you are a little bit nervous about investing in the markets, start off with doing a 3,000 Rand a month debit order. Why I say that is because let's just say markets are highs now. Again, we're not 100% sure on that, but let's just say if you do think markets are high, you're putting only 3,000 Rand a month away. You're not putting away the full 36,000. And you do that for the next 12 months, you're buying at different entry points. So that's personally what I do with my tax-free. I do a debit order every month. So I buy at different entry points. I don't just do a lump sum at one point. But again, if you'd like, what is very important is this is only a portion of your portfolio. If you would like, I'd love to obviously look at your whole portfolio, and then we can obviously assess how suitable different funds would be. But yeah, guys, that is all on my end. Those are all the questions. Again, just to highlight, if you do have any other questions, please pop me a mail. More than happy to assist. Again, this webinar will be recorded. So if you did come in late and you want to watch it, I'll send a link to the recorded webinar to everyone. But yeah, guys, thank you so much for attending. On behalf of Rand Swiss, we wish you the best for the upcoming year. I have no doubt it will be a success. And thank you so much for attending.